What is an interest rate swap? A plain vanilla interest rate swap is an agreement to exchange a fixed rate-based cash flow and a floating rate-based cash flow based on a notional principal for a specified period of time. Note that there is no exchange of principal. Swaps allow the user to exchange or modify interest rate obligations so that one is not exposed to changes in interest rates. Interest rate swaps can be used by hedgers to manage their fixed or floating assets and liabilities. They can also be used by speculators to replicate unfunded bond exposures to profit from changes in interest rates. Interest rate swaps are very popular and highly liquid instruments, and as such represent an efficient interest rate risk management tool. Payers and receivers. A swap is based on an agreed notional amount, usually involving the exchange of a fixed rate for a floating rate. In every fixed for floating swap transaction, one counterparty pays a fixed interest rate, the payer, and the other receives that fixed payment, the receiver. The motivation of the payer in a fixed for floating swap is to transform an underlying variable interest rate into a fixed rate obligation and vice versa for the receiver. Cash flow exchanges occur at predefined reference reset dates throughout the life of a swap, though cash flows are typically netted. How does it work? At each reset date, if the floating reference rate, say LIBOR, is greater than the fixed swap rate, then the payer will receive a cash payment from the receiver based on the difference between the LIBOR and the swap rate. If, however, LIBOR and the swap rate are the same, no amounts are payable. On the other hand, if LIBOR reference rate is less than the swap rate, then the receiver will receive from the payer an amount based on the difference between the swap rate and LIBOR. How are they quoted? In quotation, the swap dealer sets a floating rate equal to the benchmark, typically LIBOR or EURIBOR, and then quotes the relevant fixed rate that will apply. Consider a 5-year US dollar swap where the market maker is prepared to buy or sell the swap, making a spread of 2 basis points between his bid and offer prices, and the market maker is quoting 462 to 460. Consequently, a customer asking the market maker for a price at which he pays a fixed rate, i.e. buys a swap, would receive LIBOR and pay 462. Note that although conventions for quotation can be either 60-60 or 60-62 for the above swap, the meaning is the same. Suppose that the 5-year Treasury yield is 4.25. It is quite common for swaps in US dollars to be quoted as a spread over Treasuries. Hence, using the 5-year swap quote above and given the 5-year Treasury yield, the swap quote can be condensed into a bid offer quote of 35.37. The timing of the fixed and floating rate payments may not be identical. For example, the fixed payment could be made annually or semi-annually, and the floating payment made quarterly. In addition, the dates for resets on the fixed and floating legs can be separate, e.g. to match bond cash flows on an asset swap which are different to the funding cash flows. In such cases, unless payments are due on both legs, gross payments are made. The way in which interest accrues could also be different. For example, the fixed rate could accrue under the 365-day convention and the floating under a 360-day year, such as Japanese swaps. Swaps are used by a wide range of customer bases, drawn from both the asset and liability side for one or more of the following reasons: to obtain lower funding costs, to hedge interest rate exposure on committed and/or future funding requirements, to obtain higher yielding investment assets, to create types of investment asset not otherwise obtainable, to implement overall asset or liability management strategies, to take speculative position in relation to future movement in interest rates. The advantages of interest rate swap include the following. A floating to fixed swap increases the certainty of an issuer's future obligations. Swapping from fixed to floating rate may save the issuer money if interest rates decline. Swapping allows issuers to revise their debt profile to take advantage of current or expected future market conditions, and interest rate swaps are a financial tool that potentially can help issuers to lower the amount of debt service. Let's look at a generic liability application. A company has issued a 7-year fixed-rate debt, which is callable after 3 years and which carries a fixed coupon, say 5%. It enters into a fixed-to-floating interest rate swap for 3 years only, under the terms of which it pays a floating rate of LIBOR flat and receives a fixed rate of 5%. At the end of the 3 years, the company has the flexibility of calling its fixed-rate loan, in which case it will have actually borrowed on a synthetic floating rate basis for the 3 years, or it can keep its obligations outstanding and pay a 5% fixed rate for a further 4 years. Let's look at another example, this time from the perspective of a financial institution providing fixed-rate mortgages. In this case, the mortgage provider is exposed in a period of falling interest rates if homeowners choose to repay their mortgages and refinance at a lower rate. The institution can protect itself against this risk by entering into an indexed amortizing rate swap. Under the terms of the swap, the mortgage provider will pay typically a higher fixed rate, say 100 basis points to as much as 150 basis points above the market fixed rate, payable under a plain vanilla interest rate swap. But in exchange for this, the notional principal amount of the swap will amortize as rates fall, and the faster rates fall, the faster the notional principal will be amortized. The different applications are, of course, endless. An asset swap is a generic term for the repackaging of a debt security. They exist because investors often require a set of cash flows that is unavailable directly in capital markets. The pool of available investment opportunities in the floating rate market are considerably less diverse and, indeed, liquid than traditional fixed income instruments. By using asset swaps, the asset manager can transform a fixed rate instrument into a floating rate exposure, thereby creating a synthetic floating rate note. Moreover, investors frequently have illiquid bonds in their portfolios, and if they think that yields will rise, and they therefore would like to sell the bonds, by definition these bonds will not be sold at prices which reflect their true value, the value excluding illiquidity premium. Accordingly, an investor may decide to hedge such a position by paying fixed on a swap, agreeing to pass on the bond coupons in exchange for receiving LIBOR. An adjustment must of course be made to take account of the actual price of the bond. Let's consider an example. Assume that an investor holds a bond and enters into an asset swap with a bank. Most asset swaps are executed on a par-par basis, where the bond is purchased at a price of 100 of par, regardless of the actual market price, and an interest rate swap is overlaid with a notional principal equivalent to the face value of the bond exposure. Then, the value of an asset swap is a spread the bank pays over or under LIBOR. This is based on the following components. First, value of the coupons of the underlying asset compared to the market swap rate, and second, the accrued interest and the clean price premium or discount compared to par value. Thus, when pricing an asset swap, it is necessary to compare the par value to the underlying bond price. The spread above or below LIBOR reflects the credit spread difference between the bond and the swap rate. On the trade date, the two counterparties of an interest rate swap are agreeing to exchange future interest rate payments, and no initial payments are made. At least, this is the case for most of the trades. The swap terms must therefore be constructed so that the present value of the two series of payments on the swap will be equal at the time of dealing. For the fixed rate side, once a swap is determined, the payments of the fixed rate payer are known. The floating rate payments are not known, but forward rates are known, either from consideration of the zero coupon yield curve or from prices in the relevant interest rate futures market. Therefore, the present value of a plain vanilla, i.e. fixed rate for floating rate swap, can be easily computed using standard methods of discounting to achieve the present value of both the fixed and the floating legs. However, at swap inception, only the actual rates of the fixed leg are known in the future, so it is necessary to approximate the future floating rate payments by deriving the appropriate forward rates from the yield curve. Each floating rate is then calculated based on the forward rate for each respective payment date. Each estimated future floating cash flow is then discounted by the relevant zero coupon rate. The fixed rate offered in the swap is the rate which values the fixed rate's payments at the same PV as the floating rate payments. Therefore, the NPV of the swap at inception is 0. During the life of the swap, the same valuation technique can be used to monitor the mark-to-market of the contract. In addition to the standard transactional and dealing costs associated with any derivative, one must also consider the interest rate and credit risk impacts of dealing with swap contracts. Interest rate swaps expose users to both interest rate risk and credit risk. Interest rate risk originates from changes in the floating rate. In a plain vanilla fixed for floating swap, the party who pays the floating rate benefits when rates fall. Note that the party that pays floating has an interest rate exposure similar to a long bond position. The credit risk on the swap comes into play if the swap is in the money or not. If one of the parties is in the money, then that party faces credit risk of possible default by another party. Hence the need to monitoring and collateralization, as is the case for all other derivative transactions. Documentation is therefore paramount. Customers are required to agree to and sign a standard ISDA master dealing agreement. This standard master dealing agreement governs the trading relationship between the connected counterparties. In particular, it documents the situations in which transactions can be terminated and the way the amount payable following termination is calculated. Due diligence needs to be performed to ensure that both the counterparties and their agents are permitted by law to enter into such agreements such that there can be no issue of ultra vires. In addition to this, prior to each transaction, one must ensure that sufficient credit lines and trading limits are in place. A significant proportion of swap transactions are not plain vanilla, since many transactions are tailored to suit specific asset or liability requirements. This has opened up the market to a considerable number of product variations over and above the conventional rate risk management solutions for funding or asset swaps. Forward-starting swaps are very frequent, as are swaps that embed interest rate optionality that permit the user to either terminate a trade early or indeed to extend the designated maturity date. With the growing concern around LIBOR as a credible benchmark or the need for more bespoke rate management, swaps linked to the overnight indices such as SONIA or IONIA are becoming increasingly more popular as liquidity in these floating rate benchmarks reaches credible levels. Moreover, innovation is boundless and the need to customize client solutions grows ever more evident.